right? We really want to see interest rates, long-term interest rates, and gold going up together, right? When all that starts to happen, right, you see bonds down, dollar down, oil and gold up. Pretty much it's game over.
Peter Schiff, a renowned financial expert, sheds light on key indicators that could herald a significant change in market dynamics in this thought-provoking video. His analysis of the dollar, bond market, gold, oil, and rising bond yields suggests that a convergence of these factors could lead to a game-changing moment. Exploring the delicate interplay between interest rates, gold prices, and equities, Schiff draws parallels to historical market events, drawing attention to the potential implications for the near future. Watch this informative video to the end without skipping a beat.
People need to get out of all dollar-denominated debt as quickly as they can. And, looking at other rates that picked up on the week, I looked at the 30-year fixed rate mortgage, and that is now up to, I think, 7.4%. And, rates, I looked it up. The absolute low for mortgage rates was in 2021. It got down to 2.65%. There are people out there that got a mortgage that low. But now we're at 7.4. People cannot afford to pay these prices at a 7.4% rate. Now, remember, I looked this up too. The peak of mortgage rates was 1981. So it took 40 years for mortgage rates to go from a record high to a record low. The record high in 1981, believe it or not, was 18.45%. Can you imagine that? Can you imagine buying a house with an 18.45% mortgage? Because somebody did that, right? Because somebody must have borrowed it to set the record. But that was a huge decline over a 40-year time period. And that big decline in mortgage rates is really what enabled families to buy homes, because otherwise they couldn't have afforded it, especially given how much the prices went up. And that was how they could do it. Now, there was another way. I mentioned this on Twitter. Some people took it the wrong way. But the other reason that families were able to buy homes, it wasn't just that the mortgage rates went down. It was that married women, got jobs and helped their husbands pay the mortgage. Because prior to 1981, I mean, not as nearly as many women were working. They started entering the workforce in the 1970s. And again, that was the result of inflation. The dollar collapsed during the 1970s. And that was basically a huge tax increase on every guy who had a job, because the inflation tax reduced the value of his paycheck, his income, and prices went way up, and his salary didn't keep pace. How did he pay the bills? How did he put food on the table? Right? Well, his wife got a job, because prior to that, in the 1960s, married women weren't working. It kind of didn't even matter what job you had. It wasn't like you had to be rich to have a stay-at-home wife. You were a policeman, you were a truck driver, fireman, janitor, whatever. You could still afford to support your wife. I mean, not in the same style that a doctor or a lawyer could support their wife, but you could still support her, and you could support your kids. But after the huge inflation tax of the 1970s, people couldn't do that anymore. I mean, if you were rich, yeah, the doctor could still support his wife, but not the teacher, right? Not the truck driver. Their wives had to go get jobs. And so all these married women contributing, and the big decline in mortgage rates, that kept everybody going. That's how people were able to buy homes. Well, how are they going to buy them now? Because now mortgage rates are not super low anymore. They're 7.4 and rising. They're going to keep rising. The big bond bull market is over, and yields are going to keep on rising because of inflation and supply. That's what's driving it. Not growth, not jobs, but inflation and this enormous supply of bonds that is hitting the market without any buyers. So real estate prices have to go down. I mean, what are we going to do? Are we going to pull our kids out of school and get them to have jobs so we can pay for a house? No, all the women are already working, right? So, we've played that card. It's gone. We don't have a spare, worker to come off the sidelines and get in the game, right? Everybody's been playing. And so, prices have got to go. It's just a question of time, but also that big increase in home equity that was made possible by artificially low mortgages, but also, of course, the government guaranteed mortgages. So lending money to somebody to buy a house was also risk-free because you had full faith and credit of the U.S. government. But those super low mortgage rates pushed up home prices. And then what did that do? That enabled home equity loans. That gave a lot of Americans a lifeline. As inflation was reducing the real value of their incomes, even with two people working, they were able to cover the bills by borrowing against their homes. That was a big part of the consumer-based economy, was that low interest rates enabled serial refinancing. And every time a homeowner was like kind of running out of money, he just got to tap into that well, and voila, more cash to spend. Well, that game is over. Nobody's refinancing anymore. It's not even possible, right? And there's no more big increase in home prices. That's not possible either because nobody could afford to buy a home because they can't get a cheap mortgage. So that was another thing driving the consumer-based bubble economy. Well, again, that's gone. And so nobody really appreciates how much downward pressure this is problems for everybody. We've been riding a wave of cheap money. And now that wave is coming crashing down on our heads. And nobody has figured this out. The investors out there are just looking at these bond yields and just assuming that inflation is going to come back down and it's going to be the status quo all over again. That's never going to happen. That was the aberration. We're never going back to that fantasy land again. We have to live in reality. We are a massive debtor nation. We have an unprecedented amount of debt, and that either means interest rates skyrocket or inflation skyrockets, one or the other. And it's much more likely from a politically expedient perspective that what's going to give is inflation. We couldn't cut spending when the Republicans had the White House, when Trump was president, when in his first 2 years he had a Republican House and a Republican Senate. No cutting of any spending when the Republicans were in charge. There's no cutting of spending when the Democrats are in charge. And even when we have mixed government, spending doesn't get cut. There's no political scenario where spending gets cut. There's also no scenario really where you're going to have big increases in taxes on the middle class, right? Everybody wants to take the middle class off the table because the middle class is already struggling. The only one anybody is willing to tax is the rich. And even there, it's difficult because they still haven't been able to increase taxes on the rich. Why is it? Even the Democrats won't tax the rich because the rich are paying for their campaigns. So it's like tax increases are off the table for everybody. The only tax any politician is willing to increase is the inflation tax. Why? Because nobody realizes it's a tax and they can blame it on somebody else. And as long as they have a cooperative Fed, which they have always had, I knew for years that we would end up exactly where we are right now in this predicament. All the years that politicians promised to cut spending in the future, I knew those were empty promises. I knew those future spending cuts would never happen. Every debt deal we ever had in the past was a scam. The politicians never live up to the promises. The only spending cuts that count are the ones in the year in which they're enacted, and that never happens. So inflation is not only the path of least resistance, it's really the only viable path forward. And again, that's why the bond market isn't worried about default. But what they need to be worried about is inflation. And they're starting to worry about inflation. And the other two markets that you really got to pay attention to, because bonds have already broken to the downside, oil is broken to the upside. The key markets you got to watch are the dollar, foreign exchange, and gold. When we really start to see the dollar go down with the bond market, not an inverse relationship, and when we see gold breaking out, when we see gold rallying with oil and ignoring rising bond yields, right? We really want to see interest rates, long-term interest rates, and gold going up together, right? When all that starts to happen, right? You see bonds down, dollar down, oil and gold up. Pretty much it's game over. At that point, you got to see a crack in the equity market. I mean, the equity market may be the last one to really break. Who knows what it's going to take? I mean, maybe, again, we've already seen that. We've had some reversals, but it's too early to call that. But personally, I would think that the dollar and the gold market might be the bigger movers. And then we get the stock market. Because the stock market held out a long time in 1987 before it finally crashed. But when it finally caught up to the rest of the markets, it did it in a big way. And we may be looking at something similar to that later this year, early next year. We'll see. If it's similar to 1987, well, it'll happen in the fall, which is coming up, right? That was October of 1987. And, if it does, I'll be covering it on this podcast.
Peter Schiff's analysis sheds light on crucial market indicators, unveiling potential shifts on the horizon. As we navigate these intricate connections, Schiff's insights encourage us to remain vigilant and adaptable, mindful of the historical parallels that underscore the unpredictable nature of the financial world. Armed with this knowledge, we're better prepared to navigate the evolving landscape and make informed decisions as we move forward. So like this video if you enjoyed, share if you learned something, and subscribe if you want more videos like this. Thank you.